And the affiliation is up in question because, of course, the agreement with 10 comes to a close in June. Now, Southern Cross Media is known to be talking with 10 at the moment, but of course 10 has been quite poor in terms of rating. In fact, if we have a look at Southern Cross Media's TV revenue, we actually saw it down by 17% in the first half of the year. Now, this could mean that it either switches from 10 to another provider like 9. Otherwise, it would put Southern Cross Media on a better footing in order to negotiate its affiliation agreement with 10. Traditionally, Southern Cross Media has been a price taker in this area, but because of the very poor ratings, it could actually give it a bit of an edge in terms of negotiating price and the terms around this agreement. So it's going to be a big week for media stocks. It's already been a pretty big year for media stocks. In fact, if we have a look at Southern Cross Media, the shares have been absolutely gunning it. Just this week alone, the shares are up by 8.2%. But if I can show you a one-year chart for Southern Cross Media shares, this is what it looks like. And you can see that since the start of the year, we've seen a massive 57% rise in the shares.
Wow, that is impressive, isn't it? And look, it's been overall another record week for the Australian market generally. What have been some of the key drivers, do you think?
It's been a great week for the Australian market. If we have a look at the last 4 trading sessions, this is what it looks like. And you can see we've seen a gain of about 0.5% in the week to date. The real standout in our market has been the discretionary space this week. The discretionary sector has been the best performing area of the Australian share market. And in particular, we've seen retailers really fighting back strongly. We've seen stocks like David Jones gaining more than 8%. We've also seen stocks like Super Retail doing well, up by more than 6%, and JB Hi-Fi and Harvey Norman up more than 4% this week. So those retailers certainly doing well on the market. Also, we've seen the financial and the property stocks continuing that very positive momentum we've seen for the year. On the flip side, I guess the sectors that haven't done so well have been the materials and the industrial sectors. These are the only areas which have actually finished in the red or look to finish in the red for the week. Now, these areas have been impacted because it is dividend season at the moment, and we've seen the top stocks in both of these sectors trading ex-dividend. BHP in the materials space, which of course is the biggest stock on the Australian share market, went ex-dividend this week. And if we have a look at the industrial space, the biggest stock in that area, Brambles, went ex-dividend this week as well. Other sectors have seen some pretty big impacts as well. The biggest stock in the healthcare space, CSL, went ex-dividend, as well as the biggest stock in the discretionary space, which was News Corp, which went ex-dividend. I guess it's worth a mention that while we have seen the material sector actually making a loss so far for the week, gold stocks have done extremely well. We've seen Perseus Mining up by almost 10% there, and we've also seen Oceana Gold gaining around about 8%. So it's good to see the gold miners making a bit of a comeback after what's been quite a poor start to the year for gold prices as well as gold miners. But all in all, it's been a record-breaking week for the Australian share market. We've hit multi-year highs. We're at the highest level that we've seen since September 2008.
And Julia, I guess one of the key drivers of the market today will be that China trade number due to drop around 1 p.m. Eastern Daylight Time. I think economists are expecting a deficit of about $7.8 billion. What impact do you expect this to have on trade?
I think this is going to be taken with a grain of salt, and that's because if we have a look at the time of year in China, it's the Lunar New Year, and it does tend to distort the numbers. We know that a lot of Chinese businesses are closed in the month of February. We'll be getting the trade numbers for the month of February, and so far around Asia, if we have a look at the biggest 10 Asian economies, there's really only one other country that's come out with trade numbers so far, and that's South Korea. And that gives us a little bit of an insight because South Korea, in terms of these February trade numbers, saw the biggest export drop that we've seen in around about 7 months. So that implies that we are going to see a pretty weak import number coming through from China. The consensus is that we're going to see imports dropping by 9.1%, but that's after a very strong rise in January where we saw a gain of 28.8%. And in terms of the exports, we're expecting to see a rise of 8.1%, but that's softer than the gain that we saw in January, which was 25%. But I think what we will see the market do is maybe average out the first couple of months because of the distortions of the Lunar New Year, and that means the Chinese economy is off to a good start for the first couple of months in 2013 so far. It means that in terms of import growth, we've seen an average of about 9.9% over the first 2 months of the year, and in terms of export growth, we would have seen an average of about 11.5%. So we'll be watching those numbers at 1 p.m. But the other thing that we'll be watching on the Australian share market is that there are a large number of companies trading ex-dividend, especially in that industrial space. So we are expecting to see the industrial space coming under pressure. We'll see Boat Longyear, Downer EDI, Forge Group as well as Sedgman all trading ex-dividend on the market today. But with such a positive lead from Wall Street, the Dow Jones Industrial Average making another record close as well as another intraday high, we are expecting to see a pretty positive bias on the Aussie market.
All right, Julie Lee from Bell Direct.